This is Investing Ideas by ValueInvestAsia.com.
Hi guys, this week in Investing Ideas, we are able to invite a dear friend of mine, Ser Jing, previously my ex-colleague in the Motley Fool Singapore. We are one of the first few employee of the Motley Fool Singapore, and I work very closely with Ser Jing during the startup phase of the company and helped build the company in the first, 4 years before I left the Motley Fool Singapore. And you might have already heard the news that the Motley Fool Singapore is closing down, and I think they will finish up their services till the end of this year. And Ser Jing has recently moved on and is in the process of starting an investment fund of his own. And this week we are able to have a chat with him to find out what has been happening to him, and also what is the great idea that he has in store for us. So without further ado, let's get started.
From ValueInvestAsia.com, this is Investing Ideas, where we talk to investors from all walks of life, learn from them, and find out some of their favorite investment ideas.
Hello, welcome to another episode of Investing Ideas. This week, we have a very honored guest, my ex-boss from the Motley Fool Singapore. Hello, Ser Jing.
Hello everyone. Just to clarify, I'm not Stanley's ex-boss. He is my ex-boss.
No. Okay, so I work very closely with Ser Jing. Would you say you are employee number 3 of Motley Fool Singapore, right?
Yes, employee number 3.
Yeah, okay.
Sure.
I was employee number 4, I think.
Yes, I think so. Yeah.
So that's why I say he's my boss, and he co-lead the investment team in Motley Fool Singapore, lah. Yeah, right. So
Yeah,
we come
together
along.
with you and
Yeah,
Chin.
we come a
Yeah.
long way. We come a long way, and very honored for you to join us on our show. Yeah.
I'm very happy to be here.
But of course, before we get started into the episode, I guess maybe you can give a little bit short introduction about yourself, and also what kind of investor are you to set the stage for the audience.
Sure. So I've been working with the Motley Fool Singapore since January 2013, and then in October this year, like some of you may know, the company closed down. So I'm actually now in the process of setting up my own investment blog as well as my own investment fund. So hopefully the blog will be ready by the time this podcast or this video gets into publication. So from the perspective of where I'm from as an investor, I have actually always been very much focused on long-term investing, and I try to buy good companies that can grow over the long run and hold them for a very long time. It's also how I have approached picking stocks for the Motley Fool Singapore's newsletters. There's a general framework that I use that I have developed over time. So I think where I come from is I first think about the stock market and what is the stock market, and it's actually a place that lets people buy and sell pieces of companies. And then the next logical question would then be, if it's a place to buy and sell pieces of companies, then what would actually cause a stock's price to rise over time? And then I think the logical answer would be that a stock's price will rise over time if the underlying business actually does well. And then that leads us to another question, and which is so if that's the case, what are some of the key points that can lead us toward finding companies that can potentially do well over the long run? So I have come up with a list of criteria that I tend to look for in my investments. So there are 6 criteria in total. The first is that I want companies that are operating in large or growing markets. So I do not want companies like, for example, say Singapore Press Holdings, which has its primary business in print advertising, which is a declining industry and market. I want companies that are operating in areas that still have tremendous room for growth. The second thing I look out for is I want companies with strong balance sheets that have either reasonable or minimal levels of debt, because with a strong balance sheet, a company will be able to last through tough times, and it may even be able to grow in tough times when its weaker competitors are struggling with their business. And the third thing I look out for is I want management teams with both integrity and capability, as well as the ability to innovate. So when it comes to like integrity, some of the classic things I look out for would be like the presence or absence of related party transactions. So for example, if you are a restaurant operator and you also own raw food ingredients supplies, it's very easy for you to overcharge the restaurant if that's the case. So I look out for the absence or presence of related party transactions. And then I think a really good example on that would be like if you look at Haidilao, which is actually listed in Hong Kong. The top
Yep.
five suppliers of Haidilao are also all controlled by the management of Haidilao itself, or rather the founder, Zhang Yong. And so in such cases, there's actually a lot of room for Zhang Yong to be playing games with Haidilao and all the other supplier companies that he's controlling. But the good thing is that if you track Haidilao's profit margins over time, you realize that they have been relatively stable and at a healthy level of, I think, somewhere between like 10 to 15%. So I think looking at those numbers, the chances of Haidilao's management actually playing games through related party transactions are low. So these are some of the things that I look out for. And when it comes to like the capability and ability to innovate, I will just look at a company's history over time and think through how it has managed to grow its business or grow the types of products and services that it's providing to its customers. Then the fourth thing I look out for, which I think is not something that many investors focus on, but I think which I think is really important, is the presence of recurring revenues. So recurring revenues can actually come from a few ways. It can come from customer behavior, or contracts, or simply a razor and blades business model. So just to quickly explain, so customer behavior would be things like, say, a Starbucks or MasterCard. Each time you make a payment with a MasterCard or Visa, the company gets a cut of the transaction fee, and you make those payments over and over again. Same thing goes with like buying a cup of coffee from Starbucks. And when you talk about contracts, it would be like subscriptions. So I think a classic example would be like mobile subscriptions. You pay your mobile operator a certain fee every month or every year, and then you get the service delivered to you. And then when it comes to razor and blades model, I think a really good example would be a company listed in the US called Intuitive Surgical, which I own shares of. Intuitive Surgical makes surgical robots. But the good thing is that besides selling those robots to hospitals and surgeons, it actually also sells all the little tools and surgical instruments that are used in each surgery. And these tools and parts are actually have to be replaced after every surgery. So in a way, it generates this very strong stream of recurring revenue for Intuitive Surgical with each sale of a robot. And I think right now, something like 70% or so of Intuitive Surgical's revenue actually comes from these consumables. And then the fifth thing I look out for is I want companies that have a proven ability to grow. So I do not want just companies that promise the sky or say that they have large markets or they want to do this and achieve that. I want companies that have been able to do what they have said, or even better, do even more than what they have said. So I look at a company's track record, and that is important to me. The last thing I look out for is I want companies with a business model that gives me confidence that it can produce a high level of free cash flow in the future. So, for example, like there are companies that can generate revenues and profits, but without cash flow. So a good example would be, let's say, if you are building an oil rig and the contract takes you 5 years to complete the construction of the oil rig, but your customer may pay you only at the end of that 5 years. So within those 5 years, you may be able to recognize revenue and profits, but the cash actually does not come until the very end. So I do not want business models that have lumpy free cash flows or that have low free cash flow margins. So I want companies that can produce a very high level of free cash flow. So I think when I put all of these criteria together, it can more often than not lead me to companies that will be able to grow well and grow at a high rate over long periods of time. So most of the companies that I invest in, they tend to excel in most or all of these 6 criteria.
Wow, very, very comprehensive criteria that you list out for us. I hope all audience are actually taking notes. But I'm gonna, put you up for the test and go through the 6 points with you on this company
Yep.
that you're gonna present.
Sure,
Why
sure.
don't you go ahead and, to be honest, I always hear when we are working together, I always hear you talking about stocks in the US or even in Singapore, but very, very rarely I hear you talk about stocks from this market. So why don't you share this idea that you have for us today?
Sure. So the company I'll be talking about today is actually HDFC Bank. So it's actually listed in two of India's major stock exchanges, and that will be the National Stock Exchange of India as well as the Mumbai Stock Exchange. The thing, so the reason why I've actually not talked about Indian companies too much is because it's really difficult for non-Indian residents to actually be investing in India-listed stocks. So, and the reason why I'm looking at HDFC Bank is because the company actually has a secondary listing in the US, so it makes it a lot easier for people outside of India to be investing in it. So that's the main reason why. So HDFC is actually a bank. It's headquartered in India, and it's one of the largest private sector banks in the country. Today, it has more than 5,000 branches throughout India, and it serves somewhere along the lines of 50 million customers or so. So HDFC's main business is actually in lending. It generates about 70% of its total revenues from net interest income, which is the income that a bank earns from basic lending activities. So HDFC has a wide range of lending products. It lends not just to individuals, but also to all wide range of businesses. And then it also generates about 30% of its revenue from non-lending activities through services, through the provision of financial services.
Right. So this is a very traditional bank, lah, right?
Yes, correct. Very
India.
simple. Yeah.
Okay. And when you talk about they are listed, have a secondary listing in the US, can you explain a little bit to that for maybe our audience that are not familiar with investing outside of their home market? HDFC Bank, they have a ADR. So what really is a ADR, and are we really investing in the shares of the company? How does it work?
Yeah, sure. So ADR is the short form for American Depository Receipts. So it's actually a program that HDFC set up together with JP Morgan. So what happens is one US listed ADR of a HDFC Bank is equivalent to three actual shares of HDFC Bank. So there are today, I think, slightly over 1 billion India shares of HDFC that's listed in the US. So that would equate to about 340 million or so of these ADRs. So these ADRs are actually backed by actual HDFC shares. So and there's also a lot of liquidity involved. There are some ADRs I think in Singapore's case we also have such programs, but trading liquidity is often very poor. But in the case of HDFC, monthly trading volume has never been lower than 20 million of these ADRs. So it's a very liquid kind of listing in the US.
Wow. Okay. Cool. For foreign investor investing in the ADR, there's almost not much difference by investing in ADR and compared to if you are an Indian national and you can invest directly in the bank as well, right?
So there is a slight difference because the ADR has a small premium, somewhere in the high single-digit percentage range over the India listed share price. But that premium has kind of existed for a very long time as well. So I don't think it's a premium that will close. And in any case, I think that kind of small premium does not matter much over the long run anyway.
Okay, cool. Yeah, that's maybe something for foreign investor to take note of.
Yes.
Why don't we go back to the bank, the company by itself?
Sure.
There's so many banks in India. Why do you like this one?
So there are a few key things that I like about HDFC Bank. So I think the most important thing we can run through first is like maybe we can have a short history of India's banking industry. So India's banking system, right, has many different types of financial companies. For a very long time, the banking system was closed and it was only run by banks that were owned by the government of India. And it was only in the mid-1990s that the government opened up the banking industry, so that birthed the existence of private sector banks. And HDFC was one of the very first few private sector banks that got the license to be running banking services. And what's amazing is that since HDFC's existence, it has actually been growing its earnings per share and book value per share every single year. And the growth rates have actually been very impressive too, because if you look at, say, so HDFC's fiscal year ends on 31st of March. And if you look at the fiscal year 1996 to the fiscal year 2019, HDFC's book value per share is actually compounded at 27% per year, and its earnings per share is compounded at 29% per year. And these growth rates have actually also been at a similar level, even if you look back at, say, the past 5 years or past 10 years. So one of the key reasons why I really like HDFC Bank is that this is a bank that has been able to grow really well over a long period of time. Now, I recall Warren Buffett, in one of Warren Buffett's writings or interviews or something, he has mentioned before that he's generally wary of financial institutions that have been able to produce strong growth. But the reason why I'm so comfortable with HDFC's growth is because the bank has actually been able to grow at a very conservative way. Because if you look at, say, the bank's leverage ratio, which is total assets over stockholders' equity, since its listing, right, or rather, since the fiscal year 1996, that ratio has averaged just 11.5, and today, the ratio is around 8.5. And if you compare it to, like, say, our local banks in Singapore, DBS, OCBC, and UOB, these banks have leverage ratios of in the low teens range. So HDFC, from a leverage perspective, is in fact even safer than the banks in Singapore. But that's not just all, because the bank has also managed to grow while keeping its asset quality really strong. So the bank started reporting its non-performing assets ratio. So that's the equivalent of Singapore's non-performing loans ratio. So the non-performing assets ratio since the fiscal year 2002, right, has never been above 2%, and in fact has averaged at around 1.36% in those years. And if you look at India's banking industry as a whole today, for example, private sector banks have a non-performing assets ratio of more than 10%, whereas HDFC today is only at like around 1.4% in terms of its non-performing assets. So this is a bank that has been able to grow at very strong rates in a very conservative manner. So and it's so, you know, when looking at a stock, we're not just looking at its history, right? We also have to think about whether or not it's poised for growth going forward. So when I look at the entire picture with HDFC and India's banking industry, I think that there are really strong long-term tailwinds for the bank. So as an example, right, much of India's population today is unbanked. About 40% of the adult population of India has a bank account today. So you are looking at about 60% of India's population that still do not have bank accounts, according to government data sources. And in fact, just 2% of the population have credit cards. So access to credit and access to banking services in India is still very much in the early days. And I think that leaves a lot of runway for HDFC to be able to grow. But not only that, if you look at, say, India's population, there's also a tremendous tailwind. So if you look at from today to 2050, India's working age population is projected to increase by nearly 30%, and off a very high base. Today, India's working age population is about 860 million people, and that's projected to increase to about 1.12 billion by 2050. And if you look at, say, China's working age population over the same period, right, is expected to decline by about 20%. And in the US, the working age population is expected to grow by only about 10%. So in India, you have these very much under-penetrated banking industry, and at the same time, this huge growth in the working age population. And I think that these two are just really powerful tailwinds for HDFC. But of course, again, we have to be wary of just looking at macroeconomic tailwinds. We also have to be sure that a company would have the capability to win market share and continue to grow in its market. So if you look at, say, HDFC, right, today its market share in terms of India's banking industry is still low. At the end of 2018, the bank had about 7% of the total banking deposits market in India. And in terms of the loans market, it has a market share of less than 10%. Now, from fiscal 2013 to 2018, right, the growth rate of India's loan market in each of those years was 16% at most, whereas HDFC's growth rate in loans was actually between 18.7% to 26% over the same period. So you can see that HDFC has actually been managed to grow its loans portfolio at a much faster rate than the entire Indian entire Indian banking industry. So that's I think a sign of the company being able to win market share. And I think that if you look at the HDFC's track record, then I think a logical question will arise in that how has the bank been able to grow so well? And I think this boils down to it boils down to HDFC's DNA in the way it looks at its customers. So to HDFC, it's building a great customer experience in terms of for both depositors as well as borrowers is top of the mind for HDFC, and the bank has over the years been innovating rapidly to really just improve the entire user experience when it comes to customers using HDFC services. So for example, right, the bank was actually the first bank in India to have launched internet banking and mobile banking services all the way back in the late 1990s and early 2000s. And today, right, customer-initiated transactions in HDFC through mobile and internet channels are 92% of all transactions, and this has increased from about 30% in 2009. So, what this means is that HDFC's customers can actually conduct most of their banking activities through online and mobile channels, and this creates a very high level of convenience and usability for its customers. And if you look at from the loan lending product angle, right, HDFC has also been able to streamline its loan approval process tremendously. So it's actually the first bank in India to introduce a 10-second approval for customer loans. So for example, if you're an individual and you want to make a loan with HDFC, you can initiate that loan approval through your mobile or internet channel and get it approved in under 10 seconds. And if you're a small, medium enterprise, you can get your loan approved in under 3 hours. So can you imagine how convenient it is for HDFC's customers to be borrowing money from HDFC, right? And so when I put all of these together, I think that this is a bank that likely will have a lot of opportunity to grow in the years ahead.
Wow. Okay, you give a very compelling reason and growth potential for this bank. Let's go back to some of the question that I am thinking while you're explaining the stock to me. You mentioned that the HDFC is one of the largest private bank in India.
Yes.
The others, the large one, I guess, are government-linked banks. Is there still a key difference between the two? Does government banks still have some advantage over the public sector, and what's their relationship?
So actually, on that aspect, I am not sure. I'm not sure if the public sector banks in India are protected by the governments. But if I look at, say, the growth of HDFC and some of its other private sector peers, right, I don't think that public sector banks are afforded any form of high levels of protection, because the private sector banks have actually been able to grow very strongly since their creation in the Indian banking industry.
Okay. And maybe you can share a little bit. You talk about, about 60% of India's population are still unbanked. How is HDFC acquiring new customers and depositors? Because I assume that this is not just about opening a branch and then people will start depositing with you. It's almost like you have to educate the population that putting your money in the bank is safe. So can you compare, have some examples of how they're actually increasing their depositor base?
Oh, that's an excellent question. So I think what HDFC has done is that it has actually been very methodically building a bank branch footprint in the rural parts of India where the banking penetration is the worst. So it has so I think around half of HDFC's bank branches of more than 5,000 across the country, right? Nearly half are actually in rural areas in India. So it has made a very strategic decision to be opening bank branches in India. But more so than that, right? So HDFC's philosophy about banking is that it wants to make its whole banking experience seamless for customers. So for example, you can walk into a branch and then maybe you can get something done, and then you walk out of the bank branch, and then you can continue that transaction on your mobile device or through the internet. So I think what HDFC has done really well is to really just create this extremely seamless mobile initiative. So it has made this a very seamless experience for its customers. And so like when it opens bank branch in rural parts of India, it's able to attract people who walk into the branches. But more so than that, when they walk out of the branch, they are still able to continue their banking relationship with HDFC Bank. So I think that's one of the things that HDFC has done really well.
Okay, cool. And also you talk about like mobile banking and internet banking as well. I just want to check with you. Have you done studies on the Indian digital payment market? Because we've seen example from China how the e-wallet guys are able to grow so aggressively is because at the beginning getting a credit card in China is very difficult, and people just pivoted to digital payment as a mode of payment, and that's why it created their growth. And in India, similarly, you say the credit card penetration is very, very weak.
Yes.
Do you see a lot of the e-wallet guys in India also gaining steam in growth, and would that become a threat to traditional bank like HDFC?
So I think this is really interesting. So HDFC's one of HDFC's founders and who is also currently managing the bank, his name is Aditya Puri. So in a recent interview, right, he actually said that he is actually not worried about HDFC being disrupted by fintech players like digital wallet providers, and the reason is because the banks today actually hold most of the customer relationships, and to him, right, the most important thing is not just there are two important facades in terms of like this banking business. First is that who holds the customer relationships. So in this case, right, it's still the banks that are holding the customer relationships. Now the second important thing is that are the incumbents or are the banks innovating fast enough such that they create a really good experience for their customers? Because you think about this, the reason why disruptors can win market share is because they either are able to provide a service cheaply or able to provide a better service. Now, if you have an incumbent that is working very hard at both lowering the cost of its services and also delivering a more convenient service, then I actually agree with Aditya Puri that if the incumbent is able to continue innovating and improving the services that it provides to its customers, then there's actually it will not be easy for a new player to come in and disrupt the incumbent's business. So I think it all boils down to how the incumbent is thinking about competition. So I think in the case of HDFC, I'm not too sure about the rest of India's banks, but in the case of HDFC, looking at the way it has innovated in the mobile and digital banking space, I think that there's very little room for new upstarts to come in and take its business.
Right. Okay. From what you're saying, that I get a sense that your thesis on this company is not just on the growth of the economic, macroeconomic situation in India, and also you have some trust and in the management of HDFC as well, right?
Correct.
But let's look at, because this is still a bank and maybe not even the largest bank in India and in a very still underdeveloped country. What would you say is the key risk for this investment?
So the key risk for this investment would really be the planned retirement of Aditya Puri. So Puri has been heading and leading HDFC since the bank's founding. But in India, there are rules that bankers have to retire at the age of 70. So in October 2020, that is the time where Aditya Puri would reach the age of 70, and so he's scheduled to step down. So I think that is probably the biggest risk to HDFC Bank. But there is currently a transition plan in place. One of the bank's longtime leaders, his name is, I think, I hope I'm pronouncing it correctly, Sashida Jadikshan. He has been with HDFC since 1996 and is one of the important executives at HDFC. So there have been recent changes in terms of like the portfolios that is managing HDFC. So most of the bank's important portfolios are now under Jadikshan. So I think there's some form of continuation there in the leadership transition. And since we're on the topic of management, right, I would also like to point out that one of the really interesting aspects of HDFC's management is that that I like. So the first thing is that the bank's managers are actually paid relatively small amounts compared to the bank's profit, right? So like for example, HDFC's market cap today is about 2 times that of DBS Bank, and yet, right, Aditya Puri's total compensation is about $2.6 million, and you compare that to the CEOs of our local banks, it's way higher. It's probably around the $10 to $12 million mark. So you have a leader of a very large bank that is actually compensated at a very reasonable amount. And if you look at the incentive structure of the bank, it's also really interesting because HDFC's top management are actually compensated partly based on the bank's non-performing assets, right? So I think having that trait alone would help ensure that the bank would be very prudent in terms of taking risk, because management will not want to be want to be making bad loans to chase growth, because their compensation actually depends on the amount of bad loans that HDFC has.
Okay, I just want to go through your 6 points, right? Your 6 points on the
Yep.
company. Maybe just on the last point you talk about, where I remember saying that you like companies with strong free cash flow. But
That's
in this
right.
case, for a bank, free cash flow is quite irrelevant and it's
Yes.
hard to predict. So would that make you more worried that you're investing in a bank, or it doesn't really matter for you in this case?
So I have a small joke about investing, and often say that investing is very important to know all the rules, but it's also equally important to know when to break those rules. So yeah, so in HDFC's case, I think that, like you correctly mentioned, free cash flow is kind of irrelevant to a bank. So free cash flow is relevant for most companies, but when it comes to a bank, it's about thinking through what are the more relevant metrics. So in the case of HDFC, or rather in the case of banks in general, I look at the leverage ratio, I look at the earnings per share, I look at the book value per share, and I look at liquidity risk in the form of like the loans deposit ratio, and I look at how management is incentivized. So when I look at all these important numbers, especially like the book value per share and the leverage ratio, I think HDFC fares very well on both fronts.
Oh, okay. Yeah, fair enough. So why don't we, go straight into the more important things as an investor? How do you value this company? What is their valuation right now, and do you think they're attractive right now?
Yeah, so I think the best way to value a bank would be to look at its price to book ratio. So that would be comparing its share price to its book value per share. So in the case of HDFC, currently its book value per share is somewhere around 4.5. And that is, if you look back at history, right, that is actually not high in relation to where the bank was trading at. In fact, right, I have some really interesting statistics as well about the bank's valuation. So if you look back at, say, October 2007, so that is like where most countries' stock markets hit a high before the great financial crisis happened. So in that period, right, HDFC's price to book ratio was actually more than 8 times. And today, the price to book ratio has fallen by half to about 4.5. And yet, the bank's share price has still been able to grow at about a 13% compounded rate of return. And so, I look at today, and you might think that a price to book ratio of about 4.5 is high, and that is high. If you look at, say, compare it to our local banks in Singapore, we are trading at price to book ratios of, I think, maybe about 1.2 to 1.5. So a price to book ratio of 4.5 is definitely high. But then HDFC is growing at probably 4 times the rate of what our local banks are also growing. So from that perspective, right, you look at the growth rate and then you compare it to the valuation, then I think that it's a very reasonable price to pay.
Right. Okay. I'm gonna challenge you on that. Right.
Yeah, sure.
When I invited you to share an idea, I know you're gonna share some not so traditional type of investment, and you surely hasn't disappointed me, right? And most of the stock that you always talk to us about, unless I would say that they're cheap if they're trading below 30 times PE for you. On the valuation side, you definitely has not disappointed us. But if I can challenge you, right, for a bank, to me, I find no difference in banks anywhere around the world. I just find, they are all just banks, and I see them as a proxy to the economic of the market that they serve. So if you compare to all the banks around the world right now that we can invest in, be it in Singapore, where you say the price to book is about 1.2, 1.3, even the US, my co-founder Willie, in a few weeks ago, he presented Wells Fargo, trading trading also around 1 time book value. You have the Chinese banks now at 0.5 time book value. So you're telling me that compared to all these banks, you still prefer to, if you have to choose, you still prefer to invest in HDFC? Is that right?
Yes, correct. I would still very much.
And why is that?
So if I look at, say, the track record of growth, right, like HDFC, I think would be head and shoulders above most of all the. It's definitely way better than our banks in Singapore. It's way better than like the banks in especially the large banks in the US. Like for example, Wells Fargo. I like what Willie has presented. But it's also. When I look at Wells Fargo, I can also see that it has not been able to grow its book value per share for a number of years now, whereas HDFC is still continuing to grow at rates of above 20%. And then if you look at, say, the Chinese banks, now that one will be interesting because China's economy is also growing rapidly. So India and China are actually two very large countries in terms of their population that is still able to produce very high levels of economic growth, even though both countries are now facing some slowdown in economic growth. So if you look at, say, China, then you might think that trading at way less than 1 times book value, and with this high economic growth in China, isn't that a good thing to bank on? Perhaps, but I do not have a good handle in terms of like how these Chinese banks are lending, because in India, right, you have the public sector banks which are controlled by the state, and then you have the private sector banks, and and the state of India does not have much control over what these private sector banks are doing beyond, say, implementing rules from the central bank. But in China's case, you have banks that are in a way all controlled by the government. So I'm not sure in terms of like, have they been prudent in terms of their lending activities? So that's just one area that I'm worried about, because in India, right, it's very clear cut that the public sector banks are making very bad loans. If you look at, as I mentioned earlier, the non-performing assets ratio for the public sector banks in India is more than 10%, whereas with HDFC, we are looking at way below 2%. So like, I'm not sure if the banks in China would end up have been found to have been making very bad loans, because they are being directed by the government to make certain decisions that are in the interest of the country, but maybe not so much in the interest of shareholders.
Okay, yeah, fair enough. I buy your argument, and also I always find the Indian market very fascinating, but it's just a market that I is not familiar with, so I haven't really invested in the market. But I remember a long time ago, there's a saying, right? Somebody once said that both the India and China market are growing, but the China market is growing because of the government, and the India market is growing in spite of the government. So you sort of have to question yourself, like, which market is actually more resilient by itself, right? And you make a good point on the difference between a government-linked bank in India and a private sector bank in India. So this is definitely one of a very interesting company that throughout our program that you have presented. So I thank you once again for your time and your research. I hope our audience will enjoy this idea as well. Thank you so much again, Ser Jing.
Hey, thanks, Stanley. Hope everyone enjoys too.
So that's it for our interview with Ser Jing. You can find out more about his thoughts and his view on his blog at thegoodinvestor.sg. He'll share a lot more on some of his ideas that he has, including his investment philosophy and also what's happening in his upcoming fund as well. So definitely do check that out. And I just want to let you guys know we're going to take a short break in investing ideas for the rest of the year. as we prepare. Our team is going to start preparing for our Stock Guide 2020. As you guys will know that every year we publish a stock guide since 2017 where we highlight 10 of our favorite stock for that year. So our team is hard at work at creating that full report for you guys. So we're going to take a short break in investing ideas for the month of December and also in January. So we most likely be coming back with new episode after the Chinese New Year in February. So till then, stay tuned and invest safely, guys.
Thank you for listening. You can subscribe to our show on Apple Podcast, Google Podcast, Spotify, or wherever you get your podcast. If you are feeling generous, please give us a rating and review as well. This would greatly help other investors find out about our podcast. To access our show notes, please go to valueinvestasia.com/investing ideas and be sure to sign up for our email newsletter for more outstanding content and reports about investing. The show is for entertainment purposes only and should not be taken as investment advice. Please seek professional advice or do your own research when making any investment decision.